In systematic investing, there is a massive graveyard of strategies that look flawless in a Jupyter notebook, survive backtests, but then completely disintegrate in production. The reality is, whether you are building an alpha engine or running a seemingly simple passive indexing strategy, the initial research is maybe only 10% of the job. The other 90% is pure engineering. This includes building robust risk models, surviving market microstructure, and deploying effective optimization. Hi, I'm Hossein, and welcome to Quant Engineering. I have a PhD in finance, and my core focus is the mathematics and the statistical engineering behind systematic allocations. Academic research provides the foundation for every great strategy, whether you are minimizing tracking error in a passive mandate or maximizing information ratio in a high turnover alpha strategy. However, deploying those elegant asset pricing models into live markets such that they survive real-world frictions requires rigorous engineering. On this channel, I bridge the gap between applied econometrics, asset pricing theory, and production-grade systematic investing infrastructure. I designed this series to be the exact resources I wish I had when I started building these engines. So, if you're a quantitative researcher transitioning into industry, I'll show you how to take your empirical asset pricing research, your cross-sectional anomalies, your factor signals, and wrap them in scalable object-oriented architecture so that they survive the friction of out-of-sample execution. If you're a software engineer building systematic investing infrastructure, your biggest bottleneck is often translating opaque theories into production code. In this series, we will decode the black box of quantitative modeling. For example, we'll derive exactly where the structural covariance matrices come from and why they occasionally cause the optimizers to crash in production. We'll explore how to build execution algorithms that dynamically balance expected active returns or tracking error against transaction costs. If you're a risk or attribution manager relying on institutional vendor models like MSCI Barra or Axioma, this series will give you a clear look under the hood. Understanding exactly how these matrices are constructed is the key to mastering performance attribution, diagnosing optimizer hallucinations, and ensuring your generic risk estimates perfectly align with your firm's specific alpha. And finally, if you're a portfolio manager interested in the frontier of systematic investing, we'll explore how quantitative architectures are evolving beyond classical linear factor models. We'll examine how firms are incorporating alternative data, LLM-driven signal extraction, tree-based nonlinear signals, or integrated portfolio construction to capture alpha that traditional factor models may miss. My goal for this series is to document the exact architectural decisions and the engineering mindset required to bridge the gap between asset pricing theory and production-grade systematic investing infrastructure. No matter your background, I hope you find this series useful. While the specific pipelines we build in this series will focus on equity portfolios, the underlying architecture is universal and applicable across asset classes. But enough of me just talking at you. Let me give you a preview of what that architecture actually looks like in practice. All right, so before we do anything else, in this first video, we're actually not going to jump straight into code. We'll do a lot of coding in future videos, but before we build a system this complex, we really have to get a good understanding of the architecture first. And one practice I have found to be incredibly valuable and helpful with that is diagramming the system before writing a single line of Python. And of course, the first version of the diagram is never going to be perfect or even correct. correct, but that's not the point. The point is that the diagram gives you a baseline blueprint that allows you to think holistically about the system. And this is extremely valuable because what happens is as you build, the code exposes flaws in the diagram. So you go back, you update the diagram, and then that improved diagram actually changes how you think about the code. So you'll get this nice continuous feedback loop. And by the end of the project, the architecture and the code base converge into the exact same thing. And this convergence or alignment is extremely valuable down the line for various reasons. Imagine you're handing this off to someone else, or maybe explaining the system to, for example, a quant dev. Having that true architectural blueprint goes a long way in these scenarios. Okay, with that said, let's map out the two primary pillars of systematic investing. So we have active and passive. And we're going to start with the active side. What you're looking at here is a high-level macro view of a market-neutral active strategy. Now, for the moment, don't worry about what's happening inside each of these boxes. I want you to think of this purely as a map showing how information flows through the system. We'll zoom into every one of these modules in just a moment, but before we get into the weeds, let's remind ourselves what the actual business objective is here. So we begin with a proprietary research insight, or you can call it a raw signal. And our job is to systematically transform that insight or signal into a portfolio that generates risk-adjusted alpha, while carefully controlling our risk exposure. For example, in this benchmark neutral strategy, we must make sure we have absolutely zero directional benchmark exposure. So our active beta must be zero. Now, notice I said we want to generate risk-adjusted alpha, or we want to control risk exposure. But what does that actually mean in practice? How does our optimizer here, which allocates our optimal portfolio positions, actually adjust for risk? To see how the optimizer achieves this, pay attention to the inputs of the optimizer. The optimizer doesn't just need a forecast of expected returns that it's fed here. The optimizer also needs a forecast of how different stocks tend to move relative to one another. Or put another way, how risk is distributed across the entire investment universe. And this is represented by a covariance matrix, which we will denote as V on this channel. Now, looking at the pipeline from this altitude, we can see that the action of forecasting V is represented by this big red box here in the middle. But the difference between a toy backtest and a production-grade investment platform is everything hiding inside that box. So let's peel back this macro layer. And once we look inside this risk machinery, we see a highly orchestrated engineering pipeline. So to make sense of all these boxes that you see here, let's just go back to first principles and look at the structural risk equation. So I'll derive this equation properly on this channel in the future. But for now, the key is that in a structural risk model, that covariance matrix that we talked about is famously formulated as what you see in this structural assembly box here as XFX transpose plus delta. Now I'll talk about what these are, but if you look at the architecture now, you can see how we're essentially building this V matrix piece by piece, and how the three raw ingredients, which are X and F and delta, emerge across the lanes. Now on this channel, I'm assuming we're not relying on a commercial vendor and we're building this entire framework ourselves. So we're gonna build every ingredient of the structural risk equation from scratch. Therefore, our first engineering task will be constructing the X matrix, which is the factor exposure matrix. We can think of it as the structural map of our investable universe, or the DNA of our investable universe. Now, if you're coming from an empirical asset pricing background, this is usually the first major difference that you'll notice. Because in academic research, we're usually working with a standard 3-factor or 5-factor model or a model of that sort. And if you need a size or value factor, for example, you typically just grab the FAMA French SMB or HML data and then plug that directly into your 3-factor or 5-factor model. But that simply doesn't cut it in production because, as you can see, building X is more involved in production. We can't just use prepackaged market aggregates. We have to build granular asset level exposures from the ground up. So in the top lane inside the factor engineering engine, we define our core style factors, like, for example, value or size, momentum, volatility, etc. Then for each of these factors, we define specific descriptors. Descriptors simply reflect the different methodologies used to capture a specific style factor. So for example, we might capture momentum using 2 or 3 different time horizons. So once these descriptors are defined, we handle missing values and outliers, and then cross-sectionally standardized at each factor level, and then blend the descriptors together to get raw style factor. Finally, we re-standardize and orthogonalize across the entire factor set to generate our clean, deployable style factors. Now, looking down here in the second lane in the factor engineering engine, we define industry exposures here. And one detail I want to point out is that we don't use simple binary dummy variables for industry classification. So in a binary classification, we assign each firm to a single industry. Here, we use fractional segment regressions so that a conglomerate will be proportionally assigned to multiple industries that it's operating in. Anyway, the end result of this entire factor exposure engine is a mathematical map, which is our matrix X. Basically, we compress the universe from a massive, noisy, n-dimensional asset space down into a clean k-dimensional factor space with this n by k X matrix. And this X matrix flows directly downstream right into the risk engine, as you see. Now, remember earlier I said there are 3 raw ingredients required to build our structural covariance matrix, V, and the ingredients were X and F and delta. So at this point, we have the X matrix. And to finish building V, the risk engine has to do 2 things. First, it has to estimate F, which is the factor covariance matrix, which is a k by k matrix that tells you exactly how different style factors and industry factors move together. And second, the risk engine also has to estimate delta, which is an asset level n by n specific variance matrix, which captures the unique idiosyncratic risk of every single stock. So to get these 2 matrices, the obvious first step is to calculate our raw factor returns and specific returns first. And we can do that with Fama-Macbeth regressions. But this is where the real production-grade engineering kicks in. If you're building a toy model, you might just run a rolling Fama-Macbeth regression and then take a simple historical average of some sort. But that simply isn't enough in production, because if you rely on a simple average, your risk model will suffer from several critical deficiencies, which we will discuss in detail in this video and later, especially in the next video. For example, your factor covariance matrix will be completely blind to sudden volatility regime shifts. As I said, we'll discuss these problems in more detail later, but the main point or takeaway is that we cannot rely on naive averages. We have to engineer these matrices piece by piece. Now, we're going to do a deep dive into the exact architecture of this risk engine in part 2 of this architecture review. But for this video, I just want to give you a high-level flyover of how the risk engine is actually deployed. so that I can show you why its structure is so critical to the rest of the pipeline. Now, notice in the risk engine, after we run our Fama-Macbeth regressions, we split the risk engine into two parallel and independent tracks. In the top track, we build the factor covariance matrix. We explicitly separate correlation from volatility and then dynamically scale the matrix for market shocks. And then here we denoise it using eigenvector decomposition. Now, in the bottom track, we process the diagonal specific variance matrix delta. To process this matrix, we calculate the time series and structural components, combine these two components, and then we apply cross-sectional Bayesian shrinkage to stabilize the matrix, and finally dynamically scale the matrix similar to what we did to the factor covariance matrix. Now, at this point, we have all three ingredients. So we can combine them here at the end using the equation we discussed earlier. It's this exact structural conditioning that allows the covariance matrix to survive the friction of live trading. Of course, this was a quick flyover. There's math involved and the architecture is actually more detailed. But like I said, we'll go through the math and the architecture later. So once we have our risk forecast V, our active strategy officially starts here in the alpha engine where we process our proprietary signal. Now, as every PhD transitioning to industry quickly finds out, discovering a theoretical premium in an academic paper or an industry white paper or maybe your own research sandbox is only a step one because a raw signal is just far too noisy to trade. So on this track, we mathematically condition that raw signal. Because this is a market neutral strategy, we must make sure our active beta is zero. So we first scrub out the structural benchmark beta from the signal so that we aren't taking any incidental market bets. Then we might apply smoothing techniques to remove daily signal flicker and control turnover. And finally, we standardize here and then calibrate those scores into a pure expected return vector. And this calibration step is crucial because this is where we account for the information coefficient and also the specific decay profile of the signal. So in the alpha engine, we started with a raw, noisy signal, and then at the end, we end up with a clean vector, which is perfectly prepped for the convex optimizer. Now, we're obviously not finished with the active architecture, and we'll come back to discuss what the optimizer does in an active strategy. But for now, let's shift gears and look at passive investing, which is the second pillar of systematic investing. More specifically, rather than just studying a traditional index tracker as a passive strategy, I've decided to build a direct indexing architecture designed for tax loss harvesting. The reason I decided to include this is because I think this gives us a much richer system to study compared to a vanilla index tracker because it forces us to combine portfolio construction, risk modeling, optimization, and also tax-aware execution all in one framework. So compared to the active system, the business mandate here is completely different because we aren't hunting for alpha anymore. The goal is simply to track a benchmark, for example, the S&P 500, and here's the twist. While autonomously harvesting capital losses to generate a tax benefit. So we cannot use an ETF like SPY to follow the benchmark because we want to be able to harvest capital losses. The idea is instead of tracking the benchmark using an ETF, we're tracking it by investing directly in the benchmark's constituents, or their mathematical proxies, of course. And this is why we do it. When individual positions in our portfolio drop in value, so every year there are winners and losers in the S&P 500, right? We can choose to realize those losses to offset the capital gains in the portfolio. And we do this because this reduces the client's tax burden. And while we do this, we need to carefully maintain our benchmark exposure because that is the client's mandate. Ultimately, if the system works as intended, the client's after tax return must exceed that of the benchmark. So, to pull this off, what we're really building here isn't just a pipeline, it's a clean, event driven state machine. So let's peel back this macro layer on top and look at the actual mechanics of our passive tax loss harvesting engine. Every morning before the market opens, this system has to wake up and process reality. So it ingests overnight cash deposits and withdrawal requests, handles corporate actions and changes to the benchmark, evaluates market drift, etc. And crucially, it evaluates all of that against complex jurisdictional tax constraints. Here in Canada, that means strictly enforcing CRA superficial loss rules and also tracking average cost-based pooling. If you're in the US, that means navigating IRS wash sale rules and individual tax laws. Now, this strategy might sound simple conceptually. We just sell losers and realize losses. But when you look under the hood, paying attention to details, executing that state machine safely in live markets is actually incredibly complicated. Because, for example, the system needs to make a decision to rebalance or not on any given day. Okay, that is the first thing that the system needs to figure out. And to make that decision, the system needs to deploy dynamic triggers to decide if a rebalance is actually worth executing on that day. And this step itself is really tricky because harvesting a loss isn't just about covering your transaction costs. We can think of it as essentially an option pricing problem. Because when you harvest a loss today, you're essentially exercising an in-the-money option. By doing so, you destroy the option value of potentially harvesting a much deeper loss tomorrow. You also force the portfolio to take on tracking error because you just harvested a portfolio constituent. And on top of that, you lock yourself out of repurchasing that asset for 30 days due to CRA or IRS tax rules. So the system has to dynamically weigh all of those frictions and decide whether to trigger a rebalance or not. If the trigger is met, that is, if the system determines that the benefits of rebalancing outweigh the associated costs, then we send the optimization problem to the convex optimizer. Now, compared to the active strategy, the optimization problem changes completely. We're no longer trying to maximize risk-adjusted alpha. Instead, here, the optimizer's job is to harvest tax losses, avoid unnecessarily realizing capital gains, and most importantly, identify the optimal replacement securities that preserve the portfolio's benchmark exposure while minimizing tracking error. And here's the crucial point. Finding those replacement securities isn't just a matching exercise. To minimize tracking error, the optimizer must constantly query the risk engine for the latest covariance matrix. So even in a passive strategy, the risk engine remains the mathematical foundation of every portfolio decision. Now that we've briefly gone over the two systems, let's look at their architectures side by side. At a fundamental level, these two systems have completely opposite business mandates. The active strategy over here on the left is engineered to isolate and monetize pure idiosyncratic returns. It actively strips out market exposure to maintain strict benchmark neutrality because its sole objective is to maximize risk adjusted alpha. Meanwhile, the passive strategy over here on the right has a fundamentally different mandate. It isn't hunting for alpha. Its objective is to maximize tax yield while remaining tightly tethered to the benchmark, treating tracking error as a strict risk budget. Because these mandates are fundamentally different, the software architectures are completely and fundamentally different as well. The active strategy is a massive ETL pipeline. It extracts data, transforms it, and then outputs a target portfolio. The passive engine, on the other hand, is a path dependent state machine. It can't make a single portfolio decision today without knowing the exact state of the tax ledger yesterday. But here's the point I really want to emphasize. Despite having completely opposite business objectives and philosophically different software architectures, they ultimately depend on the exact same piece of core infrastructure. Both architectures, active and passive, stand on the same mechanical foundation: the risk engine's forecast of the covariance matrix V. In quantitative engineering, the risk engine is your map of the world. It tells you exactly how the universe of stocks moves together. And to understand why this is a single point of failure, I think it's worth taking a second to look at what happens when the map is broken. So let's look at the active engine. If we fail to split our factor covariance into separate correlation and volatility half-lives, which means using the same half-life for both, the factor covariance matrix is going to be entirely blind to macro regime shifts or too reactive to transient noise. If we fail to denoise the factor covariance matrix using random matrix theory, we're going to ingest massive spurious sample correlations. And down here in the specific risk track, if we rely purely on historical time series without, for example, applying Bayesian shrinkage to our specific variances, the system will inevitably underpredict the risk for some illiquid microcaps. These mathematical failures don't just stay inside the risk engine, they cascade. If we trace the outputs of a poisoned risk engine, it becomes evident that the downstream consequences infect the entire pipeline. For example, here in the alpha engine, our expected returns are scaled using those broken specific volatility estimates, meaning our alpha vector is now corrupted. And down here, the optimizer is fed a broken covariance matrix, which destroys its ability to accurately manage tracking error or leverage constraints. So, small estimation error in the risk engine don't remain isolated statistical mistakes. They become mechanically amplified into portfolio weights. To further understand why this amplification and cascade effect happens, let's briefly look at the optimization problem. In classical mean variance optimization, the optimal portfolio depends on the inverse of the covariance matrix, or V inverse structure. That means any estimation error inside V doesn't simply pass through the optimizer. It gets inverted and directly influences how capital is eventually allocated. But to see exactly how that noise explodes, we can look right here at the Woodbury matrix identity. Now, I included the Woodbury identity down here because it makes this amplification almost visually obvious. We'll derive the Woodbury identity later in the series and talk about the execution efficiency that we will get using the identity. But for now, just focus on these two inverse terms in the identity. So look at this term right here. The optimizer explicitly depends on delta inverse. Now, delta is a diagonal matrix that contains the specific variances for every stock on its diagonal. When we invert delta, those variances, those specific variances, move into the denominator. Think about what happens here. If noisy historical estimates cause us to underestimate the risk of a stock, and we'll talk about why this inevitably happens later, that tiny variance ends up in the denominator when we invert the delta matrix. So when we invert the matrix, that tiny estimation error gets mechanically amplified into an oversized portfolio weight. The exact same logic applies to the factor covariance matrix F. If we feed the optimizer noisy or spurious factor correlations, those errors are also propagated through the matrix inversion and ultimately distort the target portfolio weights. So ultimately, these errors will cause the optimizer to interpret certain positions or even entire factor bets as artificially low risk. So as a result, it will allocate excessive capital towards what in reality could be a highly volatile position. So what are the actual consequences for our active and passive strategies? In an active strategy, the optimizer will take on massive unintended bets. As a result, you will underperform your benchmark and you might blame your research. So all the hard work that you did on your research, you might discard. While all along, the problem wasn't your research. It wasn't your alpha signal. It was the map that was broken. Similarly, in a passive direct indexing strategy, if your factor covariance matrix is polluted with noise, then the optimizer might substitute harvested losers with completely mismatched security. As a result, your tracking error bounds will shatter and your ex-ante risk reports become completely detached from reality. This is why in quantitative finance, a broken covariance matrix is the most lethal manifestation of the oldest rule in engineering, which is garbage in, garbage out. It's like building a billion-dollar ship, hiring the best navigator in the world, but then handing them a faulty map. It doesn't matter how sophisticated the vessel is. You will eventually drift off course and get lost at sea, maybe. So before we ever turn on the optimizer, we must make sure the map we hand to it is structurally sound. And because covariance estimation is so difficult, most firms simply choose to outsource the problem. They pay institutional vendors like MSCI Barra or Axioma to deliver them the components of the risk matrix every morning, effectively treating the risk matrix as a black box abstraction layer. But that creates several architectural limitations that we will now discuss. The first issue has to do with optimizer diagnostics. As we just discussed, convex optimizers are notoriously ruthless error maximizers in that small estimation errors inside the covariance matrix can become mechanically amplified into unstable portfolio weights. If your optimizer suddenly generates massive untradeable allocations on a Tuesday morning, you must be able to understand whether the instability originated from a volatility scaling issue, maybe spurious factor correlations, maybe a bad shrinkage assumption, or the matrix conditioning itself. If you don't understand how the matrix components were assembled, or rather engineered, you basically have no principled way to diagnose and debug your own pipeline. The second argument is related to model alignment. No matter how customizable an institutional vendor model is, at the end of the day, it is still a generic product and it has to be broadly robust across thousands of portfolios, investment mandates, universes, and horizons. But your research pipeline is not generic. Different strategies require different assumptions about liquidity horizons, volatility responsiveness, factor decay, or maybe even the definition of systematic risk itself. If you build the risk engine internally, you can fine tune your covariance architecture so that it aligns with your specific alpha horizon, your execution profile, your turnover constraints, or more broadly speaking, your portfolio construction philosophy. The takeaway here is in systematic investing, the quality of the optimizer ultimately depends on how well the risk model reflects the economic reality of your own strategy. The third limitation of treating the risk model as a black box is matrix augmentation. Suppose your research team discovers a new systematic signal. This could be a new AI adoption theme, a supply chain exposure, or something that I have worked on in my own research, a proprietary innovation factor. If that source of co movement is economically real but absent from the vendor model, then your covariance matrix is structurally incomplete. This is essentially a model misspecification issue. Mathematically speaking, instead of including that systematic exposure in your model as a factor, you're forcing it directly into the residual structure. In an active strategy, this can cause the portfolio to be dangerously concentrated in what appears to be diversifiable residual risk. In a passive direct indexing strategy, this can cause the optimizer to substitute harvested portfolio constituents with proxy securities that quietly accumulate unintended factor drift and tracking error. The takeaway here is simple. The optimizer can only navigate the world described to it by the map you hand to it. It is completely blind to what's missing from the covariance matrix. And finally, and honestly, this is my favorite argument, the feature factory. A modern risk engine does far more than just produce a covariance matrix. Internally, it generates a massive stream of real time structural diagnostics, volatility regime multipliers, cross sectional bias statistics, localized peer group specific volatilities, or matrix conditioning metrics. If you buy a black box model, you don't have access to these internal state observations. However, if you build the risk engine internally, these diagnostics become an incredibly rich feature set for downstream machine learning systems. For example, later in this series, we will use the exact volatility regime shocks generated inside the risk engine as a state variable for a reinforcement learning controller. This will allow the AI to fine-tune the rebalancing and optimization hyperparameters in real time in response to changing market conditions. So the lesson here is you cannot build adaptive learning systems if you don't own the underlying state observations. So I hope I have convinced you that if we want to build institutional grade systematic infrastructure, we must at least understand how the covariance matrix is engineered. And this is exactly why the very first series on this channel is dedicated to building the risk engine from scratch. So we've established why the covariance matrix is a single point of failure and why treating it as a black box creates massive vulnerabilities in production. But identifying the problem is only step one. Now we have to engineer a solution. So in part two of this three-part architecture review, we're going to open up the black box and walk through the architecture of a production-grade risk engine module by module. We'll see how the covariance matrix is engineered to survive the real world through separating volatility and correlation dynamics, Bayesian shrinkage, volatility regime adjustments, Marchenko-Pastor denoising, and the final risk audit layer. Then, in the third and final part of this architecture review, we'll see how that risk engine integrates into both our active and passive architectures. We'll connect it to our financial constraints alpha framework, extend that architecture with LLM driven signals, and then integrate it into our tax loss harvesting engine before exploring some of the frontier methodologies shaping the next generation of systematic investing. But for now, the baseline prototypes for everything we've been discussing today are already live on my GitHub, and the links are available in the description below. The risk engine powering those repositories is a V1 baseline. It works, it produces sensible portfolios, and it allows the architectures to function end to end. However, over the course of this channel, we are going to replace that baseline and build the production grade framework that we've been discussing from scratch. So take a look at the V1 code, and once you're ready to look under the hood of the V2 architecture, I'll see you in part 2.